I host the BiggerPockets podcast. I write books about real estate. I am mostly in residential, but I've got some multifamily deals I've done with other partners. It would probably be better to say the types of real estate I haven't invested in, which probably isn't as smart as that sounds. It's better to find a niche. But I sort of, over the last 10 years or so, I found myself in a lot of different kinds of deals, and I've got properties across the country.
Awesome. Thanks, David. Mauricio.
Does this mic number 17 work?
17,
yeah,
yes.
Okay, cool. So my name's Mauricio.
Can we cut that mic?
You guys going to cut it off? My name's Mauricio Rauld. I'm actually a syndication attorney, so don't hold that against me. But my job is simple. I have one job, and that's to make sure that all of you guys that are out there raising capital do it in full compliance with federal and state securities laws and stay out of jail. So my job is to make sure you guys stay out of jail.
Obviously doesn't.
There you go.
There we go. Okay.
Wait, mine?
Hello.
Yeah.
Yeah.
That's probably getting feedback.
So this is great. You guys should definitely talk to Mauricio because there's going to be a lot of people in the coming year with some level of distress or issues. But I'm Omar Khan. I'm the founder of Boardwalk Wealth. We're active developers as well as value-add acquisition people. We've transacted over $500 million of transactions across the Midwest and the Southeast. And the focus for ours, similar to what Feras said, I really liked your presentation, it's all operations. Because during the good times, nobody really cares about it, or they don't think about it, or don't think it's important. But it's during tumultuous times like this where you really kind of figure out, and compounding all of that is, you can't just be, like say 20 years ago as an example, you could be really good at just say real estate and kind of get by. Now, that's not possible. You have to be good at capital markets, you have to be good at real estate, you have to be good at accounting, and that's what our team brings to the table.
All right.
You
I
don't
already
need an
introduced
introduction.
myself,
Yeah,
so
you
I'm not
don't-
going to go
yeah,
through that
you don't
again.
need
We'll
it.
give you guys some time to do Q&A.
Awesome, thanks guys. Well, wanted to start with David. I know you do see a lot of things, the BiggerPockets podcast. You're seeing a lot of different things, both in your business. You have a lending business. You have a booth here as well. Can you talk about maybe real estate has changed? Can you talk a little bit about what trends you're seeing that are working these days for individuals?
Ooh, that is a good question. I do have a booth in the back, so I have a mortgage company, a real estate team, then I buy the real estate myself. And I like to say I sort of sit in the crow's nest. So I will see changes happening in the markets before other people see them, just because we've kind of got our finger on the pulse. We're pre-approving people for mortgages. The problem with real estate investing today is the expectation that most of the investors have. And I'm speaking about the residential space. Obviously, we could talk about the problems with the commercial side, the entire conference. But people have been told to invest in real estate to get cash flow, okay? Buy a house, the income's more than the expenses, you have cash flow, you can now change something about your life you didn't like. So you don't like your job, you don't like your commute, you can't get a girlfriend, your cat sits on someone else's lap and not your lap. You get cash flow relatively easy in the residential space, which my opinion is residential real estate was not intended to provide cash flow. Commercial real estate is valued according to its cash flow. It was meant to create cash flow. Residential real estate, you can jimmy rig to make it happen, but it's really not meant to be that way, yet it has worked. And now we have this problem where rates have risen to the point that real estate's actually less affordable, even though the price of it hasn't gone up, but people are still coming there looking for cash flow. What's working are the investors that are using real estate as a piece of their wealth building strategy, not their wealth building strategy. So I have a book that just came out, and not to promote it, but the book was written because I think people are erring in this way. They're saying, hey, I want to be wealthy, I want to make money, let me just buy some real estate. And then they're finding out it actually, sometimes you lose money when you buy real estate. When you hold it for long enough, I don't know anybody that bought a property 30 years ago that's mad about it. Never have I met one person. So what's working today, in my opinion, is taking a longer term approach, buying in the better areas, buying something that you can add value to, learning about construction and the permitting process so that you can buy a property in a great location, make it worth more, and then over a longer period of time, the property will create wealth for you. And during that period of time, you should be working on making money and saving money and not expecting real estate to be the savior.
Yeah, that's actually a really good point. A lot of people that have invested in real estate, how many of you are more single-family investors? How many of you are commercial investors? And raise both hands if you do both. Okay, you got a few. Okay, awesome. So real estate has been a great cash flow strategy. Right now, it's tough to get into new deals that cash flow. Would you agree with that, right? That's a challenging thing to do. Another thing, when managing cash flow, we're seeing some deals that are syndicated deals, real estate, larger multifamily, commercial deals, there's been some capital calls. I've had some investors I've spoken with that, one investor I talked to said, I've had 5 capital calls that I'm involved with right now. That's a bad day, right? You get the 5th capital call. But Mauricio, I wanted you to touch on that.
Why?
Do you have
Why are
any
you
money?
putting him in the line of fire?
Do you have any money that you... Well, the reason I wanted you to touch on this is a couple levels, both as a syndicator, but as an individual. A question, we have a capital call situation on one of our multifamily deals, and one of the questions people have to evaluate is, do I put my money in this? Is this, and how would you, so I guess how would you evaluate an operator whether they should get more money after needing a capital infusion?
Well, I think there's a couple things there. Hopefully the operator has been really doubling or tripling down their communication with you, because that's usually a sign of a good operator or a good syndicator. If things aren't going well, sometimes there's a tendency to kind of stick your head in the sand and not communicate with your investors and just like pretend it might go away, or maybe there's going to be a saving grace at the end, when really a good operator is going to be, if they're communicating you once a quarter, now it's maybe once a month or once a week, or hell, it makes me daily if it really requires. And so that's kind of a good sign of whether they are a good operator that just happens to be in a situation that, the market's turned. The other thing, obviously you want to be, double checking the quality of the sponsor in and of itself. So hopefully you've already done that at the beginning before you made the investment. You did your due diligence on the sponsor, you've got information, but you want to kind of do that again and just make sure, does this person or this team have the ability to actually pull whatever, because they've given you a new game plan, right? They had the original game plan, it didn't go quite according to plan. Now they have sort of a second, like if you give me more money, this is the plan. This is the new plan. So then you have to evaluate, can they pull this new plan off, or is this just something that we're just kicking down the can and there's no way this thing is going to get saved? I can tell you there are a lot of operators out there that are in trouble, and honestly, their properties aren't worth the loan that's on them. So there's nothing that they can do to save that. One of the issues that I'm having, just from a personal standpoint, is they're not communicating that to the investors. So a lot of times the investors are already completely wiped out, but they just don't know it. Right, so you have to be able to evaluate that position. Is this deal already done? Is this, to your point, is this a $60 million deal with a $40 million loan and it's worth 30? So I mean, there's no amount of money is going to put it in there. Or is there a potential that, hey, if we put this money in there, this plan is going to work. We're going to be able to get the rents up, the NOI up, and we're going to be able to do that. So that's sort of another thing that I would really focus on. But at the end of the day, if you feel, this is really important, if you don't feel you have the expertise to go do that yourself, then go find someone, a consultant or just a friend or somebody. I mean, Feras doesn't have the time probably, but I mean, just somebody, or Omar, or any of these guys that know how to underwrite a deal, which there's plenty of people here. Show them the new deal, the new plan to them, and get some advice as to whether they think that this is really
It's
something.
funny you say that.
Make
So-
sure actually you show up to Ferris's office with all your deals.
You guys are welcome, all right? We're in the Energy Corridor in Houston. You guys are all welcome to come stop by the office. We have free snacks. Who here is in a capital call right now as a passive investors? Anybody in here? A few people, right? And we have one investor who's in 20 different deals, and he was just venting to me, right? Because he's got 5 of them getting a capital call, and he asked me if he could pick my brain and go through some of these, right? And honestly, as an investor, you have to really, operators will try to say, hey, here's the plan, we want to raise money, this or this or that. But you need to pin them down and understand what does the actual exit look like. Because as an LP, and I gave him this advice, I'm like, you are throwing good money after bad. This deal is not going to save itself. Outside of rates falling back to 5%, which is not very likely, you're going to basically put good money after bad versus just have to cut your ties and losses. And so as a passive investor, you really want to understand not just the high level, hey, we want to raise money so we can pay the note and we want to go get our occupancy up. Like, who cares, right? What does the actual refi look like? What DSCR are you going to be at? What yield are you going to be at? Do they even understand what those are? Like, some operators don't even understand what debt yield actually is, and what does a lender look at for debt yield, right? And so do they even understand that? And are they talking through and communicating, hey, by doing this occupancy, by getting another, this much more in other income, we will land at this, 6.75 DSCR, which will then let us refi out the investors for probably, no one's going to try to cash out. They're just trying to get break even, right? And then they're in permanent debt at least, and investors didn't get completely wiped, and they still own the asset.
And make sure you pay attention, like you mentioned, to the assumptions. There's a bunch of assumptions to your point, like, oh, interest rates need to go back down to 2. If that's the assumption they're relying on, then you just need to understand what those are. One important point is that when you made the initial investment, hopefully they had a good securities attorney and they actually provided you with all the disclosures. So one of the disclosures they would have provided you with all the assumptions, the underlying assumptions of their pro forma. The challenge is when they do a cash call, there is no such requirement because they're not really selling you a new piece of the deal, they're just having you more capital. So there's going to be no document out there, legal document, that shows you all the new risks or all the new disclosures or all the new assumptions underlying the new business plan. So it's really important for you to understand, to Feras' point, ask the question, what are the assumptions? And then you can then make an intelligent decision whether you agree with those assumptions or not.
Look, and just
And for that investor, there was only one deal of the 5 that I told him, hey, this one probably actually the plan could work for that, for that operator.
That's
But
usually
the other
20%.
4,
It's
I
usually
literally told him, like,
20%.
dude, this is good money after bad for all 4 of them. And I just kind of walked him through how to look at it from an analysis perspective. So.
look, just one more thing also, point that Mauricio said over here. Look, if your sponsors are communicating once a quarter, that's already a red flag, right? You don't need for the economy to go into a recession. You don't need for bad things to happen. If you've got a standard, vanilla, run-of-the-mill, down-the-fairway type of deal, you're not even getting monthly updates. That's a big problem. So you don't have to a lot of times get into trouble before you start seeing the signs of getting into trouble. And to Ferris's point, oftentimes you got to cut your costs and just move on. I mean, that's just the way it is. It sucks if you're on the receiving end of it, but that's just the way things are.
Right. I know there's a lot to be said there. The reason we talk about this is as an investor, it's like, well, how do I approach this? Some capital calls don't raise all the money, so what happens in that situation? We could spend some more time there, and we're actually going to open this up for questions in a few minutes here as well. But I wanted to ask Ken McElroy, who's sharing later, we have a session with him. He said that 2023 is the year of operations. And really, we're seeing, there's the saying, Warren Buffett, you can only see who's been swimming naked when the tide goes out, right? And so the tide has come out in some areas. So what are some signs of good operators? Do we want to start, maybe you want to start, David, and we'll kind of work our way down?
Yeah, but my opinion on this might not be the same as everyone
Well,
else's.
please share with your opinion that's
Then we
totally
wanna hear it.
different
All
than
right, and I'll take this in context, like it's not gospel, okay? It's just a perspective that I hold. A good operator is going to increase the NOI of the property, anticipate risk, and execute on their plan. But there are certain situations where it's like you can be a great surfer, but if you don't get a good wave, it doesn't really matter what you're doing. And certain economic conditions will vastly trump the most skilled operator that's out there. And it's very easy to become critical of anybody that fails. And anyone that knows me will say I'm probably one of the more critical personalities you'll ever meet. But I do recognize rates going up this high, this quickly, will just put some people in a position where the music stops and there's no chair to sit in, and they could have been the best operator out there. There's not much that they can do. So the advice that I've been giving people in order to avoid losing money is don't put all your eggs in the real estate basket. Yeah. Put a lot of your eggs in the saving your damn money basket. You should have a lot of reserves. One of the problems that we'll see with people that are wanting to get into real estate is they've saved up $40,000 and they're going to put $38,000 into one deal. It's okay to wait until you're in a strong financial position before you invest. But to answer the question, Brunson, of what you're asking, I think the best operators have a vision of what this property should be. Like when Feras was talking, he basically was describing, well, what's the end goal? What does the bank want to see? How do we get to those metrics? That's how a smart operator is going to look at it. They're not going to be given a property and say, what would I do with this? It's no, I know how it needs to look. What's the journey like to get it there? And is the juice worth the squeeze, or is this something that can actually happen? And then the other component would just be experience. You want a person who has seen things go wrong before, not the person who jumped into the game 5 years ago and raised a bunch of money and is a TikTok superstar talking about all the money that they made in real estate, and they've never seen rough seas. They just don't know what to do when things go wrong.
Yeah, exactly. I think having somebody on the team that's very experienced, sometimes more than 10 years of experience in that particular role, sometimes in that market, is really valuable.
I'll
Mauricio?
tell you, in my law enforcement career, when most of the day, when you're a cop, it's just a day. Annoying things are happening the whole time. And then every once in a while, you have a horrific experience that there is no way to have prepared for that. You don't train to be in a gunfight when you're a cop. When you watch it on TV, that's something that you're like, oh yeah, cops are learning how to fight 7 people at one time. And no, you just learn how to do the stuff you do all the time, right? So when things would go wrong, I noticed there was a huge tendency for the inexperienced people or any of the cops to go towards the veteran, the one that had done this for 20 years, 25 years, that had seen more of these events. So if you were looking at a situation like this, I'd be like, where's that old grizzled cop that's seen it all, maybe they're not the young, like, one that's hopped up on steroids, drinking creatine every single day. That looks nice. You want the one that has been around a little bit longer. Sorry to
Yeah, and we're going to have Tom Wilson's here as well. He's had 4 decades of investing. So
And he's
gonna
drinking a
share.
lot of creatine and a lot of steroids too, right?
He'll get amped up every session. So,
I'm going to give some really technical stuff here. Hopefully you guys find this valuable. So I think it's really important now to sort of really look under the hood when you're evaluating a new sponsor. A lot of times you always want to kind of look at past performance, right, of a syndicator, a sponsor, an operator. But now it's really the time to take a really good look at what they actually were able to do, because a lot of sponsors were able to provide returns, for example, for their investors back in the day. But then the question becomes, what was the reason for those returns? Most of those were because of the rate cap compressions, right? Prices just went up. Like you could literally throw a dart at one building and they were going to make money, even though they may not have operated the property very well. So you want to really analyze the pro forma or the actual results of that sponsor. Were they able, if their business plan was to get the rents up from this place, from X to Y, were they successful in getting those rents up? If they were going to get occupancy up, were they successful in getting occupancy up? In other words, did they increase the NOI? Was that the reason for the increase in value, or was it simply the rate cap compression? That's really what drove up the returns, because obviously that cap rate compression isn't probably not going to be around this time around for the next foreseeable future. It's decompression, right? So now, really, to your point, it's the operator. Like they're going to have to be able to actually do the thing that they promised before. And so you want to take a closer look under the hood and see if they actually were able to pull off the business plan and not just rely on cap rate
example,
compression.
there's a deal in Atlanta where someone bought it at 95% occupancy, sold it like must have been 13 months later at 70% occupancy, and still made money. I mean. They didn't operate it very well, I promise you that.
Right.
So.
Yeah.
But it's going to look good on paper. Hey, look, I
yeah.
returned 20% to my investors. Look, invest with me. And you're like, well, maybe not.
Well, it's amazing too, especially in multifamily. If you just like owned multifamily property between 2010 and like 2020, 2021, like you look like a genius just for owning, right? We have properties we own and like we own it and it appreciated a ton. So sometimes it's better to be lucky
Come
than
on,
good.
you're not saying real estate people have an overinflated ego.
They have their own inflated ego?
You don't think real estate people have an overinflated ego? You're not saying that.
One warning sign. I'll give you one stat that came up, and I think it's a year old now, so maybe it's changed a little bit. But there was a stat that came out of a year ago that said that 70% of investors, or 70% of syndicators that are out there had 3 years or less of experience. 70% of syndicators a year ago had 3 years of experience or less. So just.
When the waves are good, everybody looks like a great surfer.
So look, a couple of points to that. First of all, I think every year is a year of the operator. And only operators will tell you that. It's just that in some years, the difference between, say, focusing on operations and not focusing on operations might be this much, but in bad times, it's like this much, right? So every year is a year of the operator. You can always eke out a few extra points if you're a better operator, you've got a good team. What I tell people is, look, a lot of times people get fixated very much on, say, an Excel spreadsheet or the number on a presentation. But as in investment banking, I can tell you this. You can make any number appear on a spreadsheet at any time, and I can assure you, 99% of these people in this room will not even know how this number came up into existence, basically.
You'll tell a good story for it.
Yeah. If you tell a good story, right? So what you're really trying to look at are qualitative aspects, number one, if you're starting out. Qualitative aspects are stuff like character and competence. Does somebody have a good character? You can't just plug it into Excel and kind of figure it out. You have to spend some time, get to know them, do your due diligence. And do they have the competency to do it, right? Because, as an example, somebody could have great character. They could be a complete idiot. And that's not really a good fit for your money. And conversely, they could be world-class at what they do, but they're a complete shyster. They're like a Bernie Madoff type person. And that's also not a good fit. But these are things you can't just put on Excel. These are things you got to do the work on. And lastly, when you're looking at an investment, I would suggest that, let's assume you have an hour to look at something to assess, right? I would spend 59 minutes and like 30 seconds or 59 minutes and 45 seconds of that hour on the people, the team. By the way, not just, hey, can this person put a nice fancy deck together? Look, who are the actual people? Who do they have in operations? Who do they have in accounting? What is their capital markets experience like? What is the tenure of these people? I would spend all of that time on that. And maybe the last 15, 30 seconds on the actual numbers of the deal. Not that they're not important, but the fact of the matter is, you're betting on the jockey, not the horse. And oftentimes people learn this the hard way. Once they go through a turbulent time, they lose a lot of their money, unfortunately, and then they start focusing on these items. You don't want to get to a bad situation and then start learning all of these things.
So Omar is a chartered financial analyst, which there's 100,000 in the country, very smart guy. It only takes him 15 seconds to analyze deals. So if Feras won't look at your deal, you can get Omar, he'll look at your deal too.
But he's right, the property is always sort of the last thing. I mean, you always
Yeah.
start with sort of your, Robert Helms taught me this, your personal investment philosophy. Like, what are you looking for? Are you cash flow? Then it's about the market. Like, what market are you going to look at? Then what's the team, right? And then finally it's the property. Like, the property is like the most interchangeable.
And
one of all.
oftentimes people start at the bottom.
They always start
and
at
then
the
they
bottom.
start going up,
That's
which is
The
really
opposite.
just the wrong way of looking at it, I feel.
Feras, anything you'd like to add?
Yeah, I mean, it's operations. I didn't realize Ken was saying that because I've been saying that longer than him, for the record. Right? This is last summer. I'm like, dude, the next 2 years are going to be all about operations. And it's about understanding who's really operating the deal. I mean, for us, we've continued to hire on. We've been hiring like crazy, just getting the best in class we can find out there in the industry. One of our friends was basically saying, man, we're stacking the deck. Because we've just been bringing on really awesome people out of the industry, super seasoned people that have been doing it for 30 years, super strong references, and bring them on to just help make sure we can do best in class. Our management company, as big as it is, it's funny because I was literally reviewing the financials 2 days ago. We made $7,000 last month, right, on like $400,000 of revenue, right? That, we've continued to invest it all back into the operations, the people, the back office, because where you make money is actually on the
back
assets,
office, yeah.
right? And it's really understanding what's going on. And, the bigger thing is what I said earlier is understand what the operator is doing. What is the actual exit? And it's okay if that changes, right? Like, again, like David was saying, nobody expected a rate. If anyone tells you, oh, I knew rates were going to go up to 8%, bullshit. Like, that is just such a lie. Nobody expected that, right? So now the rules of the game have changed. A good operator is going to reevaluate what the play they're going to do is, right? And do they have a play that makes sense? And a good operator might be the first one to say, hey, investors, like,
It
there's just
doesn't
no
make
path
sense.
forward.
Yeah.
Like, let's just be honest with everybody. We're going to go take a hit on our record with the lender, and, there's we don't want you guys to lose more money. And I don't know if I'm an investor, would I respect the operator? I think I'd respect the operator for that. Would I invest in them again? Maybe, right? But ultimately, you need to, it means they didn't mitigate risk. But as a investor, you need to understand, like, what is the operator going to do? And does the operator see it? First, are they just asleep at the wheel? Because hopium is the worst drug ever. There are so many people that are just sipping on hopium, saying, well, yeah, we're going to go raise a little bit money so we can pay our note for the next 6 months. I'm like, and then what? Right? Like, you're still so far off on where you need to be. And so really evaluate that and see how they're communicating and what their vision is. Right?
And look, a couple of points in that, because you brought up Atlanta. I think I saw that deal. The thing is, it's all an occupancy play right now. I don't care what market you're in, unless you find if you're a serial acquirer, right? You have a big platform, you're buying a couple of deals a year, maybe you're developing a few deals a year. The name of the game in most markets right now is how much can you push up occupancy. So it's really interesting when I still see syndicators, some very big names, by the way, saying, we're gonna get $500 a month in rent premium, deal after deal, like every single deal. Like, the market conditions have worsened. You have less leverage in the deal. So, at least all things being equal, your returns go down. But magically, your returns are exactly the same, if not better. How can that be? He's an operator. He's in a couple of markets. I'm an operator. Sometimes you also have to use common sense, right? You can thumb through like 50 pages of disclosure, or just kind of use common sense also. That's also kind of important.
Yeah, that's great. We're going to go to some questions here in a minute. Before we do, I have tremendous respect for each one of these individuals in their real estate careers and what they're doing. Would you guys each take 30 seconds and just, here's something I would do if I were just starting out, or here's one piece of advice I would give. And again, it's not financial advice for you, it's just financial advice that we're putting, there's disclaimers we have to give, but all the disclaimers, so go ahead, David.
I'm sitting at the first seat of the poker table right now. I got to figure out my bet before I see what all these guys, the cards they got.
I'll go for you. I'll go first if you want me to start on my side?
Well, let's start with Feras.
All right, I'll start, but David, you better have a really good answer.
Yeah.
All right.
He'll just say, you took my answer, so that's what I was
If you're
going to say.
brand new into multifamily, go freaking be a manager. There is so much that happens at these properties. It's so naive where people think, I'm going to buy this property, hand it off to a management company. Whereas like me and my partner will literally just go office out of the properties just to see the noise. And there's a lot goes on. And so I think as an owner, you do yourself a favor if you just go manage a property for like 60 days. Just go understand, because you learn the mechanics and you learn what is achievable, what's not. And so if you have the time, the wherewithal, I think that will get you far. I haven't done that myself, but I've been close enough where like I'm freaking sitting in the properties just seeing what's going on. But I think that if you're brand new and you have the time, that's probably the biggest value you can do to yourself.
That's great. Thanks,
For me, I'd say pick a role and be very specific about that role. So if you want to be an investor, as an example, learn investing. Don't try to be a property manager. Don't try to be a sponsor. Don't try to be a developer. Don't try, because people get into the habit. I've met a lot of people saying, hey, I want to learn. But if it's useless information you're learning that is not applicable to what you're trying to do, then you're just wasting your time. So if you want to be an investor, learn investing. If you want to be a property manager and get into the game that way, you become a property manager. But be very clear with what your end goal is and what steps you're going to take. Because I often feel a lot of times, people get some money in their pocket and it starts burning a massive hole in their pocket. It might take them 2 years to save for that money. It'll probably take them 3 months to lose all of it. So be very specific with what you want and what steps you have to take. Be intentional with it.
Thanks, Omar.
If you're just starting out as an operator and you want to be an operator, you want to be an Omar, a Feras, and David, you want to be that in the future, one of the things I've seen that's worked really well is just go find someone who's already doing it, who's raising capital, and just go see how you can add value to that person. So, Feras, hey, I can do this, I can do that, and then just be a 1% or 2% GP in that, but just add, it's not about how much money you're getting or how much cash flow, how much percentage, but how much value can you add to the particular sponsor or operator. That way you can just absorb all their knowledge, get hands-on experience, and that's how most of my clients who have started off scratch, they'll go and partner with somebody, very small percentage, but they're there to learn. They're not really there to get the cash flow or the returns, and then eventually they'll graduate after they do 2 or 3 of those, and they'll do it on their own. But that's the best way that I think you can learn is to actually do.
Yeah, unless you're an LP in a deal, lose the idea that real estate is passive income.
Yeah.
That's one of the greatest lies that marketers have created to sell you on their course. This idea that if you just do something hard for a short period of time, you will then coast on the money that comes after it. A lot of deals have fallen apart because the people took their eye off of it and they handed it to somebody else and it became passive income, but that person doesn't really give a shit how that thing performs. They can always pass the buck and say, yeah, somebody else didn't do what they were supposed to do. Become a human notification system and tell you there's a problem rather than solving a problem. Nothing in life works that way. You don't get to get really fit and then be like, all right, I have passive fitness.
That's the problem. Now I understand.
You got a good answer. You got a good answer. I like that.
You guys bought me some time here. That helps. I don't know any woman who's ever been like, I love that my husband worked really hard to make me fall for him and trust him and fall in love with him. And then once we got married, he's like, I have a passive marriage. We're good. I don't have to work anymore, right?
That box is checked on to the next thing.
Yeah, stop thinking that real estate will be the exception to that rule.
That's good. Good word. We're going to do some questions at this time, some great words here. I'm going to give this to Elias. If you have a question, go ahead and raise your hand. We'll get to you here in a second. Some awesome tips here. I hope you're taking copious notes. What I would say, you can go ahead and pass, there's a couple questions over, you can pass it out, and then we'll pass the mic around. Maybe you can stand and pass the mic there. I would say there's 2 things, and I talk about this in my book. These are the rocket fuel I used to 20x my net worth over 4 or 5 years. The first is networking, right? Being in the room at places like this, and not the kind of networking where you're just handing out business cards. It's where you're trying to say, how can I create myself to be a person of value to this other person, right? Because all these guys that we all have issues we're trying to deal with in our business, right? So if somebody were to come and say, hey, I want to help you, it's like, well, that doesn't mean anything, but it's like, well, how does this work in your business in this way, and could I help here? That could be really valuable, right? So think about what they need. The second thing is education. You're getting educated being in a room like this. I read a lot of books every year. I think I finished book 72 yesterday, right? So read lots of books, learn networking and education. I know we've got a question here. Let's go to the question, sure. And it can be for the whole panel or it can be for an individual, so let us know.
I'll just open up for the whole panel. Guido with the W2 Investor. Question, this is more about occupancy. So as return to office has already begun and it continues to gain momentum, can you have a perspective or a thought on markets that may be weakened by people going back to the office, having to go back to the cities where their offices are at? And conversely, what cities do you think can possibly benefit from the workers going back to those cities?
So primarily office space. Questions about what are we...
Well, no, it's actually around multifamily.
Multifamily, going back to how is that going to affect? Does anybody... Maybe you guys on the end have any thoughts on how
I
that
don't
will
have an
impact?
opinion.
The question is ultimately what cities
Yeah.
got the
Okay.
most
Yeah.
bang for the buck
Thank you for
because of,
phrasing.
Right,
people
so-
stopping working at their
Yeah.
office.
Right, so a lot of residents have, because of work from home, they probably move to other cities, enjoy, lower cost of living, and they
Probably
work
more the
remote.
rule, like a Boise's maybe an
Yeah.
example. I don't even know, I don't have the data, but like something like a Boise probably got the benefit of it. There's probably a lot
Maybe
less
it's probably
jobs, so
like
maybe that's going to pull back at.
Look, the other question you probably have to ask yourself is, you might find a market. Can you actually even operate in that market? Let's assume you find 5 of these markets. You just have no way of operating in those markets. So a lot of times while these questions, I understand where they're going, you also have to, like I said, be very intentional. What are you trying to do? Because if you're just looking at, say, markets in California, then that question and that answer becomes a lot different than, hey, how is it nationwide? And what can I do? So
Right.
that's why.
Great. Thank you so much. Let's take a couple more questions. We've got time for maybe 2 more questions. Great. Hey, Rick?
What's up, guys? This is probably for Omar and Feras. You know, with floating rate debt, we felt fairly insulated by forward curves, and you know now we know in retrospect that they missed by a long shot, and those were the best and brightest coming up with those figures. So I just want to get your opinion on the future of floating rate debt and forward curves, and then also may now be the worst time to be locking in fixed debt.
Yeah, that's a great question. That's the multi-million-dollar
If
question.
we knew that answer, I would not be in real estate.
You know,
I can tell
the
you that.
forward curve
I would
was-
not be in real estate for one, for
Yeah.
sure.
Yeah, and the forward curve, so for those that don't know what it is, right, essentially it's looking forward, what do they think interest rates are going to be? And that was always just a big guess, right? And if you ever, I don't know, there's a thing called the Harry chart. If you go search for
The
forward
Penske
curve or
one,
Harry
yeah.
chart, where you could see previous situations, all of the different forward curves and how it looked versus reality, right? It's a big guess. And so ultimately, who knows what rates are going to be? I agree with you. Then that's where, like, we have a deal with a 5-year cap. I'm like, let's just wait it out another 2-3 more years because I don't want to refi and lock in, high rate. But ultimately, again, as an operator, it's not about, hitting the highs and hitting the lows at the right time, right? If you can refi today into a fixed rate, I remember 6 months ago, same question. Oh, well, are we already at peak? Well, if I refi now? Well, now you look smart if you refied 6 months ago instead of now. Right? And so it's about if a refi makes sense economically, you can still park it, be in a safe loan, have the yield that you need, and it makes sense. Now you're taking a gamble of, well, do I, keep playing the game or do I just, take my wins off the table?
Look, man, I'm going to put my glasses on so you think I'm a smart guy, okay? So here's the deal,
Doesn't
right?
follow us so hard.
Well, appearances matter a lot, right? So look, there's a saying, bears make money, bulls make money, pigs get slaughtered.
Yeah.
Right?
I say that actually very often.
So the fact of the matter is, like to Ferris's point, a lot of people are trying to time. Okay? If you have that, first of all, nobody in the world has that ability to consistently time. And if they do, it's post-fact. Like, they did it without knowing it and then realized, oh, God, it was just good timing. But that's sheer dumb luck. So what you have to do is look at your transaction, look at what, number one, can it support, for how long can it support, say, floating rate exposure. Then what you also have to look at is, do I, as a group, or my personal, say, financial capabilities, have the amount of liquidity and reserve on the side and on my personal balance sheet? If things go sideways, can I afford to float it, as an example, without doing a capital call? And if you have the ability to withstand that, go for it. You can take floating rate exposure. But a lot of people that end up asking this question are people who themselves do not have a good, say, balance sheet. And that's not a judgment call on somebody, right? Because if you're doing $30 million deals or $40 million deals, you were 95% leveraged, and you found some KP somewhere at a conference, and your net worth is $2 million or something, right? Yeah, you're in for a world of hurt, right? But say, if you're worth $100 million, you got $50 million in liquidity, dude, you can take a lot of exposure and come out on the other end somewhat scarred, but not dead. So forget about timing, and figure out basically what can your deal support, and then if things go sideways, what does your group or you have personal capability to support?
And right now we're in like the part of the cycle where it's about basis.
Yeah.
Right? Like nicer quality deals, like good bases, right? Figure out the debt and make sure you can stay in it long enough. But if you can pick up the right deals, you probably come out on the back end of it looking, very good. But you have to make that.
But you have to
work.
survive that valley of death, basically.
All right, guys. Well, I really appreciate it. I realize I got to get some glasses like Omar so I can look smarter.
Yeah. I don't know if that'll make you look
Well, no, but
smarter.
the bald head also
The bald head
helps with
also
you,
helps.
looking
Makes me look smarter.
sharper
Yeah,
too,
exactly.
so.
Yeah. Awesome. Well, let's give him a big hand for being on the panel today. This is great.